All right, I start recording. Okay, so Sanjay, the floor is yours.
Okay, welcome everyone to the Accounting Design Project virtual event of this week. My name is Sanjay Biziser. I am from the University of Amsterdam, and I will be the moderator of this session. I'm pleased to introduce Professor Stefan Reichelstein from Stanford and University of Mannheim, who will present this paper titled Corporate Carbon Accounting, Balance Sheet and Flow Statements. Before we give the floor to him, just a couple of comments. First of all, I would like to ask everyone to mute their microphone when they're not talking, just to reduce the background noise. Second, we would appreciate it if you would turn on your camera, if that's possible. That makes for a better session. And finally, if you have any questions, please use the reaction function to raise your hand, the reaction function in the app, rather than the chat. If we use the chat, it gets all over the place. That's not very useful. So please raise your hand and Stefan will respond to you. And if not, we will notify him. So thanks for being here. And let me hand over the presentation to Professor Reichelstein. The floor is yours.
Okay, well, thank you. Let me first say that this whole seminar series on the accounting design project is very much to my liking. When I transitioned from economics into accounting by now some 35 years ago, that was exactly the angle that we were pursuing at the time, coming from the broader mechanism design perspective. And we were really seeing accounting institutions in particular on the internal, on the managerial side, very much as design variables. The paper that I want to present to you today is also very much in the design spirit, in that we are sort of in this project really with this paper trying to develop a notion of carbon accounting, corporate carbon accounting, that hopefully will turn out to be more informative, provide more accountability for companies than the existing frameworks that most companies are following today. So let me briefly share here the screen so that I can go to slides and make this also. Let me just see this here. Where are we? View. Okay. Is this visible for everybody? Yeah. Works? Okay, good. So let me sort of begin really, since I presume many of you haven't really sort of been following this whole field, start with what you may call sort of the incumbent way that companies go about reporting their carbon emissions. When I say carbon emissions, let me also say right away that I'm going to be using the terms a little loosely here in terms of CO2, carbon dioxide emissions, while in reality, we're really talking about a carbon dioxide equivalents. There are other greenhouse gases, but I think that's, for many companies, not sort of a serious issue and distinction. Secondly, there are ways of converting and aggregating different greenhouse gases into a single currency. So whenever I say now carbon emissions, I mean so many tons, kilograms of CO2 that are being emitted by a particular source. So here, this greenhouse gas protocol, first, and it's perhaps really important, while it's sometimes referred to as a carbon accounting system, I submit it really isn't an accounting system the way we usually think about it, in particular as an accrual accounting system. What the greenhouse gas protocol really does is it provides a classification of different types of emissions. And you see here, it's sort of grouped into three different scopes. Scope 1 being sometimes referred to as the direct emissions. Think of these as really all the CO2 that's being emitted from sources that the company has operational control over, from tailpipes, smokestacks, and the like. The greenhouse gas protocol then also looks at, sort of says companies should also report their indirect emissions. And over on the left, we basically have the whole upstream emissions that are being incurred by the firm's suppliers. There's a carve-out in this category of scope 3. Those are the so-called scope 2 emissions that only sort of pertain to electricity and heat, so energy broadly. So these are the emissions that arise when the company buys energy from outside suppliers. We can discuss for a long time why this has been sort of carved out of the general upstream scope 3. Probably one of the main reasons is that people feel this is easier to measure and track than some of the other upstream emissions if you go further up the supply chain. In other words, here you sort of basically need to frequently only look at your tier 1 suppliers in this. The Greenhouse Gas Protocol also says you should at least attempt to track the emissions that arise from the use of the products and services that you, the company, are providing. In other words, if you are, say, a car manufacturer, you should report as part of the carbon footprint of an automobile the anticipated, expected, estimated emissions that arise from this automobile being driven. Same, say, for an aircraft manufacturer. So the logic there is we have some data on what the typical use of these products is, in particular if they're mass-produced, customized products, and therefore we should add that in, and therefore get to a whole life cycle analysis for the emissions associated with the company's operations. So you see here on this first slide, I think there is consensus among everybody who tries to actually implement this. And so far, it hasn't really been much of a must, but we're getting there, is that the implementation of the Greenhouse Gas Protocol has been quite uneven, incomplete. Lots of studies actually that in academic journals that have documented that companies really sort of pick and choose in terms of what they're doing here. From an accounting perspective, the thing that strikes you immediately is the Greenhouse Gas Protocol does not do a proper distinction between stock and flow variables. So when assets, for instance, are being acquired, how do you account for that? Do you take sort of the whole emissions associated with that asset and include that in this year's count? Or do you somehow or another capitalize and prorate? Natural idea for most accountants. And the third issue that I want to sort of point to here, that's in my mind is ultimately of really crucial importance when it comes to an incentive from an incentive perspective, the incentive for companies to actually reduce emissions, is that the way this is being done, because this is so complex and you're supposed to reach that far into your upstream supply chain, into your downstream use cases, the companies have really typically outsourced this altogether to so-called life cycle analysis consultants. So they go around and basically do work with input-output tables and industry averages. And that's a critical word here, secondary data that are being used to track this. As opposed to primary data, which seek to actually measure and track the emissions that have actually been incurred at a particular stage of the supply chain at a particular point in time. Yeah. So thus far, you can sort of think of most companies have really not attempted, unless they had to say because there were regulatory policies in place for when it comes to, say, to carbon pricing, when they sort of report according to the Greenhouse Gas Protocol, it's typically based on secondary outside estimates, which use industry averages. 1 ton of steel requires that much in carbon dioxide emissions. The problem with that is if you now actually are successful as a company in reducing your emissions, that will not be reflected at least not in the short term and not on one for one in terms of your reporting under the greenhouse gas protocol, as long as the life cycle analysis consultants on the outside still track industry averages. So this is sort of what I've just described is, I think, the state that we have been in for quite a few years now. More and more companies are sort of taking this seriously, are beginning to fill this in. When it comes to scope 1 emissions, we of course had already the need to report and measure. There it's a little different than what I just described on the previous slide. In particular, if you have carbon pricing regulations in place, those, however, typically only pertain to your own direct emissions. Yeah? And you see here sort of the jurisdictions that, that have done that. And this, in terms of measurement, reporting, and verification for scope 1 emissions, has been relatively uncontroversial in those jurisdictions that have had these regulations. We're getting sort of increasingly into a situation where publicly listed companies now also have to report in their annual reports some scopes of their emissions. You see here the UK mandate that came out relatively early in 2013. In the US, the SEC has recently come out basically with guidelines that suggest that companies must report annually, certain companies must report their scope 1 and 2 emissions. Notably, the SEC has stayed away from scope 3 in this mandate. The European regulators are coming out now with the so-called European Sustainability Reporting Standards. And they're, interestingly enough, they are not stopping at 2. They are basically sort of going back and saying the categories outlined in the greenhouse gas protocol, scope 1 through 3, ought to be and must be part of companies' annual reports in the future. So this is going to kick in this year, 2024. And as you can imagine, it has quite a few people here in Europe nervous that are anticipating to have to do this in ways that they may not have in the past. Let me sort of switch over here for a moment, and ultimately, I hope these two perspectives are going to come together. Voluntary carbon disclosures. We have, of course, with sort of the urgency of climate change being, told to us more and more often. We have seen an increasing number of the largest companies. You see here my top bullet point, really issuing so-called net zero pledges. So these are typically of the form, we, XYZ, will be carbon neutral by 2050. Some companies say a little bit more than where they're going to be in 30 years. They will also sort of tell you, we have certain milestones and certain reductions ought to be attempted by those milestones. Those disclosures are both at the company level. So I refer to these as corporate carbon footprint measures, but also at the product level. And that will be actually the focus of where I'm going in a minute. But the thing that I want to show you with a couple of examples right now is in terms of really preparing these metrics or measures of either a corporate or product carbon footprint, you have enormous variations. So this is sort of what I'm concluding with here on this slide. Anything like generally accepted carbon accounting principles aren't there yet, as far as I can see. That would, in my mind, go sort of a great deal to make these, particularly these voluntary disclosures, more credible, because I think there is a great deal of skepticism, and rightfully so, when all of these companies have sort of come out with these pledges to say, this is where we're going to be in 30 years. The frequent sort of worry counter argument here is this is rife with greenwashing, and companies are doing a lot of things in that domain to just sort of please certain stakeholders without really putting any muscle behind this. So here are a couple of examples of these net zero pledges. In our backyard here in Heidelberg, Germany, we have the cement manufacturer Heidelberg Materials, used to be called Heidelberg Cement. Now they're called Heidelberg Materials. So they will tell you, for them, it's relatively easy, because their sort of product portfolio is relatively homogeneous. It's essentially cement and sand, gravel, but only the cement is problematic when it comes to carbon emissions. And they're also relatively early in the supply chain. So basically, it's sort of all their scope 1 emissions that matter in this. Everything else is almost sort of secondary in this. So they will tell you, we will achieve a certain metric on average. We produce different cementitious materials. We will get this down to less than 400 kilograms for 1 ton of cement. You may say that's still a lot, 400 kilograms for 1 ton of cement, but that just reflects that the cement industry single-handedly in the aggregate is really responsible for roughly 8% of total global emissions of CO2 in the world. They will also tell you that by 2050, they will be producing carbon neutral concrete. And of course, people have been rightfully sort of going, well, exactly how are you going to do this? And what type of averaging will you be using when you say either by 2030 or by 2050, we will reach these types of goals that we've stated here. Let me give you very briefly 2 more examples, just to give you, again, more of a sense of how much these voluntary pledges differ across companies and across industries. Here's Microsoft. It will tell you that we really do try to track all 3 scopes. And in 2022, that came about to 11 million tons. Now, if you sort of think about Microsoft and its business, measuring its scope 3 emissions, in particular on the downstream side, must be an enormous challenge. I don't know much further about how they go about this. They want to be carbon negative by 2030. How do they do that? Well, essentially, they will buy a lot of so-called removal offsets. That is, somebody on their behalf withdraws CO2 from the atmosphere. That's, as you might expect, is very expensive. And Microsoft has sort of been entering contracts already where they're buying CO2 removal offsets to the tune of something like $600 per ton, which is, of course, a very high price relative to how carbon is being priced around different parts of the world at this point in time. Finally, there is another goal, and that says we're going to eliminate all our legacy emissions. So there, you're beginning to get sort of close to a really an accrual accounting system where they say, ever since we started Microsoft in the 1980s, we have been emitting CO2 into the atmosphere. We feel responsible for all of that. And so if you add that up, these are our legacy emissions. And we're going to go on a path through these removals where we will actually eliminate all our legacy emissions by 2050. At that point, then we will consider our business to be climate neutral. Contrast this with Google. After all, very comparable in many ways. When you look at Google's annual reports, they'll tell you scope 3, as far as we are concerned, in terms of what we're willing to track, it's really employee travel and commuting. End of story. Okay. Furthermore, now in contrast to what you just saw from Microsoft, we have already been carbon neutral since 2007. And furthermore, we have eliminated all our legacy emissions and did so a couple of years ago, 4 years ago to be precise. So you go, okay, how is that possible? These 2 companies that are that similar, both in terms of how long they have been in existence and in the type of business that they do. Largely, their emissions are associated with the operation of server farms. That is a large part. Yes, they have a little bit of hardware manufacturing, but it's negligible really in the grand scheme of things. So the answer here is Google has been for several decades now a major investor in renewable energy projects all around the world. By far the largest renewable energy developer in the world. So what does that mean? They will install wind farms or solar farms in different parts of the world. That part then goes into the grid locally. And Google's logic now is, and this is really where we get into the accounting issues for the first time. Google's logic is because of the green carbon-free energy that we paid for, we financed these plants. Somebody else did not consume dirty energy, carbon-intensive energy generated, say, from fossil fuels. And we claim the credit for that when we do our own corporate carbon footprint accounting. That's the logic. Microsoft, in contrast, won't do any of that. And that's why they look, by comparison again, so far behind what Google is doing. So I could sort of give you 20 more of these examples to give you, but I think you get the sense now. This is all over the place at the moment in terms of how companies go about calculating and then reporting their current corporate carbon footprints. Okay. So let me switch over for a moment to the product side, because as I mentioned, this is something that companies are doing increasingly. If we again sort of do voluntary and mandatory reporting contrasts, in particular, European consumer product companies have been, I mentioned 3 here, 2 of them being oil and gas companies, sort of have been going out relatively aggressively in recent years. When you buy gasoline at a gas station in the Netherlands from Shell, they will tell you you're buying carbon neutral gasoline here, okay? Question, how do you do that? The answer is, at the moment, this gasoline is for all practical purposes obtained and manufactured the same way traditional crude oil-based gasoline is manufactured. But these companies all invest major amounts in so-called carbon offsets. And that's where we're getting into the whole domain of the voluntary carbon offset markets that have been growing by leaps and bounds in recent years. The one thing to immediately note, while these markets in terms of volume have been growing rapidly, the median price for these offsets, say for 1 ton of CO2 on the voluntary carbon markets, has actually been falling. So the Financial Times actually had an article just a couple of months ago where they sort of analyzed that the median price had now gone down to something like $4 per ton of CO2. So that number, of course, ought to arise suspicion from just about anybody. How is it possible? If it were possible to effectively offset emissions that cheaply, we probably wouldn't have to have a seminar on this, or we wouldn't have to do any further work on this. In terms of mandates, there's also now sort of a push to really track carbon emissions on a product basis. I mentioned here the US Inflation Reduction Act, which basically provides tax subsidies, in particular production tax credits for hydrogen, sort of says the amount that you are eligible for if you produce so-called green hydrogen depends on the carbon content of the hydrogen that you produce, allowing for different ways to really ultimately manufacture the hydrogen. The problem, when Congress passed that act in 2022, and there's a lot of money riding on this, there was no specification of how we measure the carbon content of different types of hydrogen. In particular, if this uses electricity because it's so-called electrolytic hydrogen, what's the carbon content of the electricity that is being used to produce the hydrogen? Should you include that? the Congress was silent on this. It is now still an ongoing process, it's my understanding at Treasury, to actually interpret the rules here that ultimately determine what subsidies companies will be eligible for. And then back sort of to the European perspective, a huge issue that's coming down the pipe very soon is the so-called cross-border adjustment mechanism, sometimes abbreviated as CBAM. So what does this do? It basically says European manufacturers who are subject to emission pricing in the EU under the EU cap and trade system, where they're paying in most industries something to the tune of $80 to $90 per ton of CO2, should not be at a disadvantage. So therefore, when in the future goods come into the EU, there is going to be an assessment what their carbon content is, and then this cross-border adjustment mechanism, this tariff, is going to be calculated so that basically the importing party pays a tariff that would make them indifferent had they sort of been manufacturing this in Europe and therefore incurred the emission charges under the cap and trade system. So to do that, you once again need some kind of mechanism that assesses if a ton of steel comes in from India to the EU, what is the carbon content of that ton of steel, because that becomes the basis of the tariff. At the moment, I have not seen any sort of serious attempt to see how they want to implement this. But again, I think this is supposed to come into full force within the next 2 years, by 2026. Okay, so the concept that a number of companies have sort of been pursuing, and I'll give you some examples of companies that have, in my mind, sort of been innovative on this, is to say, we're going to, if you go back to the greenhouse gas protocol here, we are willing to take principally responsibility for the emissions incurred in the supply chain. However, only in the upstream supply chain. That, in principle, we ought to be able to track and to measure, not necessarily ourselves, but in a decentralized fashion. And this is where we're coming back to the issue of primary and secondary data. Okay, so what are they saying here? They're basically saying, we want to track the carbon emissions in the upstream supply chain. And we're taking responsibility for our own direct carbon emissions, abbreviated here as CE and in the following slides, and in all the inputs that we are acquiring. So it's really an extended sense of responsibility, and we can debate this whether this is reasonable, but it's very much consistent with the basic principles of the greenhouse gas protocol, where they're saying, we have some control over our supply chains. We can sort of at least nudge our suppliers to also reduce their emissions. And some companies have been very explicit that they expect improvements from their suppliers, and that is a condition for these suppliers remaining suppliers for them. So in other words, they do not only want to sort of track quality and price of the inputs they're buying, but also the recorded carbon emissions in those inputs. So from an informational perspective, in my mind, the key thing here is you will have in-house information when you now calculate the carbon footprint of a product, of your own production activities, generally multiple products, many different sites, all those issues that we sort of understand from cost accounting. You can track also and measure your own direct emissions, and you will have hopefully reliable information on the indirect emissions that are coming to your doorstep, to your gate. This is where the term cradle to gate product carbon footprint comes from your suppliers. And the question now is, is that last piece of information, that is the carbon footprint of an input of a component that I'm buying, has that been calculated by my supplier, or has it still been obtained in the way I explained earlier on? The greenhouse gas protocol is still currently being implemented, where somebody does some kind of LCA, life cycle analysis, secondary thing. So this system of sort of a sequential or recursive cradle-to-gate PCF calculation, in order for that to really work, it will have to be pushed up the supply chain gradually and sequentially in order to really have numbers that reflect current, ultimately incurred, that is actual emissions in the current period. We're not there yet, but there are some companies, as I hope to convince you here, is the first one. BASF, the German chemical company, has actually been going out with that to really create their own cradle-to-gate PCF measurement system that they're applying at their own plants. But importantly, they have also been licensing the software for this own PCF measurement system, and have been encouraging, not to say nudging, their suppliers to do the same thing, so that they can report now actual emissions incurred for those inputs that BASF buys. And currently, you see, this is my last point here. This has been started roughly in 2021-22. Currently, BASF will tell you, I actually just attended a talk recently, that about 20%, so it's a little higher than what I'm showing on the slide here, about 20% of their suppliers now do their own PCF calculation at their facilities. And that is, to them, an important step to make these numbers sort of more reliable. So that brings me then to, if you sort of have this, and I could give other examples of companies that have been going in that direction, for instance, in the automotive industry. But that gets me then to the notion, if this is being now really pushed and gradually implemented, can we really get to something even more sort of systematic in terms of an accounting system? And this is where I sort of come in with these carbon emission statements here.
We have a question there.
You have the question, Stevie.
Yeah, in terms of BASF looking to its suppliers to implement a system, I imagine there are many products that are produced by these suppliers. There's a total carbon emission. How does the allocation over products to the products that BASF actually buy? How do you do that? How do you handle that one?
Yeah. When it comes to BASF itself, a particularly sort of complicated issue, because BASF, they have something, if I remember correctly, it's in the tens of thousands of different products. And they have what makes this allocation issue particularly hard for them is that it's a lot of joint production processes. In other words, several products move through the same stage, incur emissions at that stage. And then it's like as you may recall from cost accounting, there are different ways, different drivers you can use to allocate these joint costs or joint emissions to different products. But it's, of course, there's generally, from cost accounting, we all recall, there is no true method here, depending on what you do here. So it's a question then, and this becomes, when I sort of tell you some of the industry associations. So for instance, BASF is part of an industry association called Together for Sustainability. That is actually the different chemical companies around the world are contributing to. So they will actually tell you when it comes to, say, the allocation of joint costs here or joint emissions, we will only consider certain allocation methods to be legitimate. In other words, some that are mentioned in the textbooks are ruled out because of worries that these things are biased. Yeah. So it comes to things to, should this be value-based or should it be physical volume-based? These are typically sort of the questions that they're looking at here. So in other words,
what is a legitimate, I mean, if you can trace them to individual products, I understand that, you know, like an activity-based costing thing.
Right.
But is there a legitimate joint cost allocation or joint carbon allocation? How do they come at those? What's legitimate? What's not legitimate?
so the concern is that you could sort of use your allocation system to strategically bias the carbon footprint that's assigned to products where you think your consumers are either particularly sensitive or insensitive to it. Yeah. And then, so sort of a classic example is if certain products here, in particular when it comes to chemicals, are byproducts, that is, they don't have much economic value, that you don't allocate too many emissions to those.
I see, yes.
So something like a value-based approach becomes the default if the different products are too unequal in terms of values. That's sort of the kind of recommendations that this industry association will issue and BASF plays by when they do their allocations. Yeah. They also will insist, sort of, if they get now one of their suppliers to actually follow the system and adopt their software, they want to certify that they have used allocation procedures that are really in line with sort of the accounting principles that are laid out through these industries. So it becomes basically sort of a standard setting type of body that they then in this industry want to play by. So the direction that sort of this paper goes in is, okay, this is all what I've just described, in particular at the product level, is of course familiar to us from cost accounting, product costing. Yeah, it's just that we're tracking the emissions in products rather than the cost accumulated in products, and we can presumably build on the cumulative wisdom of the cost accounting field and literature for many decades. That still doesn't solve the question for us. So how does this now all come together, sort of, when we try to get at a measure of the emissions that a company at the corporate level has incurred in the past year? So this is where the proposal is really to go to a carbon emission balance sheet and a flow statement. Think of the flow statement really as an income statement here. And it's going to come down to a measure of carbon emissions in goods sold. Think of this as an analog of cost of goods sold. The CE balance sheet is supposed to track basically certain variables over time. It's going to represent the stock variables. And the idea or the hope is that this carbon emissions balance sheet, if it were reported annually, say as part of the annual report next to the financial balance sheet, would give the reader information about the companies, as you see here on the slide, both past, current, and future emissions performance, at least certain pieces of information. So in particular, the system would get at this notion of properly separating stock from flow variables. And it basically pertains to the carbon emissions in the firm's operating assets. So that's sort of the overall domain in which this system would operate. Yeah. So here is sort of a very rough first schematic of this balance sheet. You have on the left-hand side carbon emissions in assets. Think operating assets, both long-term and short-term. And these are beginning balances, so all in terms of tons of CO2. Over on the liability and equity side, you have what I call emissions transferred in. So this is basically when you receive goods from your suppliers, be it a long-term asset or just a component that you use in your production process, you would record that here as emissions transferred in. You would keep track in a cumulative sense of both direct emissions and direct removals. So these are not the annual direct emissions, but the cumulative direct emissions and direct removals. I'll come to that later on, hopefully. And then there is finally sort of an account equity. And equity is nothing more than the sum of past carbon emissions in, carbon emissions in goods sold accumulated. So as long as our products have carbon balances, that is, there's carbon emissions embedded in them, equity is going to be negative, and it's going to become ever more negative, because it's ultimately this measure of carbon emissions in goods sold is really a damage measure that the firm's sales products have contributed to the global climate in the current period. Yeah? So the only way to get equity, and say companies like Google or Microsoft that I mentioned at the beginning that want to eliminate their legacy emissions, they would have to get that equity position down to zero. Then they would have succeeded in terms of that goal. That would sort of be the benchmark here. Okay, perhaps with an interest in, with a look at the clock here, I'm not going to go through the transactions here. This is double entry bookkeeping in standard form. This audience won't take this audience long. Think of basically a manufacturing process in which we have operating assets, we have work in progress, finished goods, and as the production sort of now takes place, we're recording emissions, allocating them if we have multiple products, or both over time, so intertemporal accruals, but also cross-sectional accruals across different product lines. Yeah? The paper sort of describes the transactions here. Transactions being materials being loaded in, depreciation charges, and the like. And because this is a balanced double entry system, of course, in each row, the entries have to sum up to zero, or credits have to be equal to debits. Sometimes it may only concern assets, in which case, say, then the sum of the debits here has to be a zero. All of this sort of runs through an annual cycle. What this sort of here is supposed to show really is only sort of the bookkeeping. There must be, just like in financial and managerial accounting, there must of course be an underlying product carbon footprint measurement system that is, so here we're really now getting to the issue of the allocations. And in all of this, it is, in order to do the assignments to work in process and ultimately finished goods, which will then determine the product carbon footprint of that finished good. In all of this here, we have the analogy from cost accounting in that of what is an acquired part, a component that goes into my product or service is typically a direct cost. So there we don't need any allocations generally. But our scope 1 and 2 emissions, say energy being consumed or tailpipe emissions at our own plants, that typically plays the role of an overhead item. So there, in most environments, in particular when we come back, say, to a BASF or an automotive manufacturer, there would be plenty of need for allocations. And Steve already, I think, sort of, got to that point. The question is, to what extent should companies really be allowed to do this and determine sort of this PCF measurement system on their own in order to capture sort of the relationship between cause and effect? In other words, it is the emissions. The emissions are caused by the activities, and the activities are required by the products. Or should this sort of be more regulated or constrained here as part of generally accepted carbon accounting principles, so as to avoid sort of companies playing games with these types of allocation schemes. Whatever the answer is to that, and I think this is sort of up for grabs. And I mean, if I talk to, say, there's Catena X, just to throw this out, is an industry association for the automotive industry that has both European but also US and Chinese manufacturers in it. They have, for instance, written a rule book on what they consider to be a legitimate PCF measurement system and what sort of boundary issues they're pursuing there. But this is, once again, this is up for grabs and will probably always remain a somewhat sticky issue as long as we want to go down the product route here before we get to the corporate level. Yes, I am. You need to unmute yourself.
Oh, can you hear me?
Yes.
Yes. I have a few questions. I think a few slides back when you showed the balance sheet, right? I can understand that bookkeeping process, yes, this one, is that whenever emission transfer in and then out will be reported as kind of emission in goods sold. But my question is that what if the customer is the end users like you and me? How the producers will have the incentive to actually transfer most of the emissions out by allocating all of that to the emission in goods sold, because the end party are the individual consumers who are actually not accountable for the emissions actually being allocated to the final goods we are buying, right? It works for intermediate producers from input and output, because all the parties from the upstream and downstream are concerned about what would be the net amount or book value of the emissions left in their balance sheet at the end of each reporting period. But once we are facing the end consumers, in the traditional cost accounting or financial reporting, there's a cash transaction or some credit sales. But in this situation, the end party, which is the individual consumers, are not accountable for anything we transfer the emission to them. So like, how do we think about what's the end of the cycle of this product?
Yeah, you're absolutely right. So this is basically a system, and that's it. Its very purpose that is making the end consumer supposedly aware, in addition to price and quality of a product, of the carbon emissions that were required to deliver this product to the consumer. And so now then the whole idea is this ought to be informed. If consumers care about climate change and want to make, through their consumption decisions, a contribution here, they will pick products that required fewer emissions in the supply chain, in the production process, until it came to their doorstep. You're absolutely right. From there on, sort of here the system ends to some extent. Now these products go, I mean, we're getting into some issues. How do we deal with recycled products? That becomes sort of a subtlety in all of this. But if there is no recycling for a moment, then you're right, this whole responsibility accounting system sort of ends with the moment at the time when the end consumer says, okay, on those terms, with that price and with that reported carbon emissions having gone into that product, I'm willing to buy it.
Thank you.
Hmm?
I think there are a few questions in the chat.
Yes.
Okay, I have not been following the chat, so perhaps if did you want to read what's in the chat, or do we? I can't see the chat here. The way I have it in full screen mode.
Maybe I can pick it up. So we have one comment by Peter Pope, who mentioned that the joint product carbon allocation problem also seems relevant on the downstream output side. And so he mentioned it in an example about cement versus gravel aggregates. He argues that if not most use of gravel involves some use of cement or other carbon intensive product like tar, in that case, gravel really is carbon neutral. So that's a comment that is made that if, and I guess this is following up on something you said before, if you go from one to the other, and what extent does offset each other?
Right. So if you were to view, I mean, I don't think cement is a good example. In chemicals, it's easier. I don't think anybody would sort of say gravel and cement go through a joint production process. They separate out very early. So there, I don't think you you would face that type of issue, but you face it in a lot of different industries. Generally, the same issues that we have when it doesn't need to be a joint production process, but a group of products requires common resources, then we get into the allocation issues.
Okay, so the issue is that through this allocation, something can become carbon neutral. And yeah,
or it could
it's
be,
complementary.
yeah, or it could be biased downward. I don't know whether you can get it to carbon neutral. You might have to choose a very extreme allocation base. Yeah, but this again, there is just like when it comes to the allocation of overhead costs, there is no silver bullet here in my mind. This is something that the systems will have to deal with. That there is a certain subjectivity and a certain need for discretion in allowing companies these things. And that's what I mentioned earlier. Some of these associations are sort of grappling with to what extent they want to leave it into the discretion of companies to design that allocation system to the specifics of their production process, and to what extent they want to regulate it so as to sort of prevent or minimize biased allocation systems. There is no good answer. You can say when it comes at the end of the day, when I get to, let me sort of leap forward, you can say, well, the good news is when we get to carbon emissions in goods sold as the aggregate measure, then these types of these indeterminacies sort of in terms of allocation methods really wash out again, because unless you really have a situation where you have large changes in inventory, either depletions or buildups of inventory, ultimately as long as the system is balanced at each point in terms of totals, the total amount of kegs. So if everything that is being started also flows through to sales in a particular period, the total kegs number, which is sort of my measure of a corporate carbon footprint, is unaffected there. Jung, you want to jump in one more time?
So I have a similar question to Jim Olsen, is that when we look at the balance sheet, how do we think about a unit of measurement? Because assets actually are physical goods and raw material work in progress. But the liabilities actually are CO2. So
No. The assets are everything. Otherwise, I could not.
CO2?
Everything is in terms of tons of CO2.
Oh, okay.
No. I mean, the balance sheet is balanced.
Okay.
We have another question from Jonathan Glover.
Jen?
Hi, Stefan. So
Hi, John.
the liabilities are cumulative numbers. They're cumulative amounts that have been transferred.
They are
in?
cumulative, yes.
And so how do you interpret this cumulative balance of whatever's been transferred in? I would think that, you ultimately care about the net.
Well, so I mean, I lost a little bit over the removals. This is actually sort of technically, this is sort of a contra liability count. Let's focus on the direct emissions for a moment, if you're okay with that. So it's a cumulative number, and then when we get ultimately sort of to the question, this tells me since we started keeping track of this, the total direct emissions that I have been responsible for. So in each period, when we have here, here we go. Here it was actually my direct emissions in a particular period were so much that was charged to our work in process accounts, to our products. And then my ending balance at the end of the year is what I had in direct emissions up to that point in time, plus current direct emissions. So again, companies that have ambitions to, over time, undo their net direct emissions, for them, the total of these two numbers, this being a positive and this being a negative number, removal by definition is a negative number, that cumulative, the total, the sum of these two numbers would have to approach zero in order to reach their net zero goals.
Yeah, I think partly I'm having trouble, understanding why I really need double entry here. I think, if I don't I get to net zero by just seeing that the carbon and the assets has been, anyway, let me think more about it. I don't think I've got the question quite right yet.
Well, so it's basically, it's a breakdown of the different components that have been accumulated in your assets. So let me perhaps here at this point in time,
Stefan, also, you have
listen, I am the clock. I know give me one minute here. So when John asked the question, do I need this? I don't know whether I need this, but I'm arguing it's useful. I get, at the end of the day, with ending balances, I get to a set of carbon emit, what I call performance indicators, KPIs, K carbon performance indicators. I can look at direct net emissions added in the current period. I have the flow measure and an intensity measure. I can look at carbon emissions in assets that will tell me something about, provide a lower bound on future emissions that will show up in carbon emissions in goods sold. And of course, I have this metric here. These are the legacy emissions that some companies are chasing. Do you need a double entry system? No, but I think it keeps track of stock and flow variables properly. And it gives you, if you look at that balance sheet and compare the beginning and the ending balances, it gives you a couple of key metrics that a lot of companies say have made promises about. Okay, I know I'm living on borrowed time here. You want?
Yeah, I think you can wrap it up because you have 3 minutes and we also have then final slide.
Okay. So I hope to have sort of convinced you. I mean, in all of this, when it comes to carbon accounting, I think there's a lot, in my mind, a lot to be said to really use financial and cost accounting as templates. Usefulness of that, in my mind, at the end of the day, sort of rests on what metrics are we picking up if companies were to report these aggregate metrics. And that's what I sort of just showed. What is still missing, in my mind, to really sort of now move in the direction of generally accepted carbon accounting principles, is a whole bunch of measurement questions. We talked a little bit about this whole question about what type of, how much discretion should companies have in choosing an allocation scheme. The biggest issue that I tried to allude to early on with my examples is the so-called offsets, the removals. What is a legitimate removal? In order for it to book and recognize a removal, do we need to be assured that it is what in the language of this whole field is called permanent? In other words, we know it will not reverse. On the other hand, certain nature-based removals have a certain chance of reversing. In other words, the carbon that you have stored, you've only stored permanently and it will be re-released into the atmosphere. That's a possibility. The question, and accounting, in my mind, and in particular a system like this, could deal with that precisely with the same type of instruments that we have seen in financial accounting, such as a contingent liability that you would record here if there is a chance, if you cannot sort of be assured that this is really a permanently sequestered and removed from the atmosphere.
Okay, thank you. I think due to the time, maybe we could wrap this one up. I still see some comments in the chat, so maybe after you've wrapped it up and people want to stay.
You tell me. Here is my closing bell. I think I've actually said most of it. If I sort of make another sales pitch in addition to what I've already said, this framework ought to be relatively easy for auditors to certify because of all the parallels that we have with existing financial and managerial cost accounting systems. The big next thing in my mind for this to be really to be taking off and for companies to adopt, it of course requires ERP enterprise software solutions. But there again, I'm pretty hopeful, not only from the BASF example, I'm getting some indications that some of these enterprise software providers are actually implementing something along those lines based on a double entry system that will result ultimately in a flow statement and in a balance sheet. If we had this, I think relative to where we are at this point, both in terms of mandates and in terms of voluntary reporting, I think we would have more transparency and more accountability ultimately as firms sort of embark on this decarbonization path. And most importantly, the incentives to decarbonize, if these are actually incurred emissions as opposed to assessed emissions based on industry standards, I think the incentives are a lot stronger than they are in the current system. All right, now I rest.
Thank you.
Do you want to still make an announcement about, I'll stop sharing? I know you want to make an announcement about the next seminar.
You see the next Tuesday will be the last event of the season. Here Leon will present Revisiting Accounting Entropy, a summary measure of accounting numbers classification. I encourage all of you to register for the next week's event.